So we've got about 10 people. I think we can just sort of kick off from here. So welcome everybody. I guess this is going to be the first of what I hope will be many to come in the future. Of a series of just a few of us covering our thoughts on Lemonade, some of the developments going on, and also to give people an opportunity for Q&A. I think between Brian, myself, and Jake, we've all done pretty extensive amount of research to have fairly well, I want to say concentrated. I'm not sure if Brian, you're still as concentrated as you were previously, but I know that Jake and myself are pretty much all in at this point. So yeah, I mean, I'm not really sure there's much more to it than that. I guess I just wanted to start off by saying I think Lemonade is probably one of the most mispriced assets in the market right now, and I think over the next decade, it's going to be a very interesting story to watch unfold. And I honestly just can't wait for the future to see what this company continues to do in terms of execution and how they continue engage with the retail investor community. Yeah, that's just kind of like some opening comments I had. I don't know, Brian, do you want to say anything to sort of kick off?
First, yeah, I'm highly concentrated in lemonade. I've been 100% in the past, which is, of course, I like to be a little bit more diversified, but that's how I feel about lemonade. But yeah, I only own three positions, so I'm very concentrated on lemonade. So today, I thought there was like three main things to kind of kick off with. One, things to cover. Lemonade turns 10 years old, so that's a massive deal. And then there's a reinsurance update, and then we got some cool new marketing campaigns that'd be interesting to talk about. So I guess starting off first, I mean, Lemonade turns 10 years old, so congrats. 10 years, that's a pretty good amount of time, and I think now's kind of a good time to compare, your thoughts of where Lemonade is today versus maybe where they were 5 years ago at IPO.
No, sorry, mute. Teething problems. Yeah, I mean, it's actually huge, a huge difference. I remember talking to Daniel, and I don't remember the exact figure he gave, but they have significantly multiplied their entire book of business since the IPO. And if you look at the IPO price, I think the IPO price was $29 out of the gate. And I think on the first day it popped to like 50 something. So the fact that the business has made as much progress as it has over these last 5 years, they've been through so many of the growing pains of going through this massive inflation cycle, and then at the same time having to. I do think that just to be frank, I do think they overextended themselves into home just a fair bit,
Yeah.
and so had to deal with some of the sort of blowback from that, right? So you have massive inflation, then you have a lot of like regulatory lag, and then you have regulators not wanting to approve much higher rates that are very much needed for a lot of these jurisdictions. So it's been really fascinating to watch them go through a lot of these growing pains, make adjustments to their business. Daniel used that great, and I think it was an analogy used at the first investor day where they talked about how much gas you have in the tank, and if speed and time are your primary concerns, then you don't really care about how much gas you're going through, which is kind of cash in this sense. But if you know that you've only got, a certain amount of cash in the tank, then you have to sort of like slow down your speed a little bit and then sort of make the necessary adjustments. So I think having watched them go through these growing pains, having made these adjustments as needed to their business and still maintain their growth, although it was pared back for just a bit, I think has been really impressive. And I think that is, if nothing else, I know that the stock went all the way down to $10, but I think if nothing else, watching them go through a lot of these growing pains and make those adjustments and then still sort of come out with, a strong message about the future, which again has been so consistent with what they've been saying since day one. I think that's been really awesome to see. So it's definitely made me very happy to see this company progress since the IPO to where we are today.
Definitely, yeah.
Yeah,
Sorry, Jake,
you
you
cool
want to?
if I jump in for a second, Brian?
Yeah, yeah, sure.
Yeah, go ahead, Jake.
Okay, yeah. So, I first of all, I just want to say that I'm very excited about the reinsurance changes. But let's keep on the topic here of what's changed over 10 years. Because 10 years, I mean, happy birthday to Lemonade. That's uh, that's a long time to be running a company, and I think this kind of gets into one of the things that I really like, which is that as humans, we tend to overestimate what we can accomplish in the short term, but then we underestimate what we can accomplish in the long term. And I think 10 years is starting to get into that like long-term range. And it is insane what they have accomplished. Even from 2018, looking at some of the slides that, Brian has shared many times in the past, they back in 2018 had like 100,000 total customers, and now they're at over 2.5 million customers. Like that's a 25x in total customer count in like 7 years, I believe. And if you just look at like the last 5 years from when they IPO'd, like was just mentioned by Neil, and had a closing price higher than the current price. As like back then in 2020, it's like they were well under a million customers, and now they're 2.5 times the size, and the stock price is lower. So it's just, when Neil says that this is what he believes like one of the biggest mispriced opportunities in the market, it's like this is the reason why we've just seen a decade now of fundamental, incredible execution on a world-class level. Doing things like reaching 1 million paying subscribers faster than Spotify, faster than Netflix, like a truly world-class company. And we've had a decade of education, of execution now that we can just look back on. Yet somehow, despite this, when looking forward, there's just still a crazy amount of skepticism, a crazy amount of doubt, a crazy amount of questioning, a crazy amount of short interest. $733 million bet against this only $3 billion company. It's just wild when you look at the track record backwards, and then the disconnect of people's belief looking forward. So that's all I wanted to say about the birthday thing.
Yeah, I mean, those are great points. I've got a couple more stats too on just the incredible growth they've had since IPO. And remember, when they IPO'd, they were, only 5 years old. And if you think about it, in your first 5 years of a business, starting with like, a piece of paper and notes and writing what you want to make out of your business, there's a lot of work in that time. That's a lot about the concept and what you're doing, and just trying to get off the ground running. So the last 5 years, we've seen, incredible progress, especially. And if we look at, their initial IPO in force premium, their first shareholder letter, it was 155 million in force premium, which was 115% growth year over year at the time. But if we look at today for their IFP premium, they have 283 million just in pet. So almost twice the amount of premium in pet today. A product that wasn't out when they first IPO'd. It was still like an idea concept back then. Car right now is 122 million, so it's almost getting to the amount that they were at IPO. And then homeowners / renters is at 503 million. And this is at the 5 year mark. So previous quarter. So their growth is just incredible here over the last 5 years. It's really, they have new policies that they didn't offer before, that nobody thought of. So 5 years ago, nobody was thinking pet was going to be such a big deal, and it is today. So, I'm really curious, now that they have full momentum going, because we didn't have ChatGPT when the public release, when they launched. I'm curious, with things like ChatGPT and AI, where they'll be the next 5 years. And I think, the next 5 years is going to be way more exciting than anything they've done over the last 10 years.
Yeah, and I think that's another point that I think is underappreciated by also a lot of bears who cover Lemonade, which is that a lot of the independent retail investors who are invested in Lemonade, like I don't know about you guys, I'm pretty sure you have, but I've been using ChatGPT to like turbocharge my own research process as well. There are so many things that I didn't know about insurance that I'm able to learn and educate myself on by using ChatGPT. And I've been using it since day one, like very extensively, to talk to it about insurance and all things insurance. And so a lot of the gaps that I think would have existed before in my understanding have largely been filled. Like, that's not to say I know everything about it, but I do feel like using ChatGPT has been an immense tool and also just furthering and accelerating my research. So I think that's also been equally great. And so I think the other advantage you get from doing that is you also get to see how the tool itself is advancing, and then sort of knowing that um, Lemonade is utilizing the best of ChatGPT, as well as other models that they're sort of growing in tandem with the functionality of this software as well.
Neil, I want to read a quote on ChatGPT that Daniel said in the 10-year letter that was just published yesterday. So here's what Daniel Schreiber, CEO of Lemonade, said. He said, "Here's a simple litmus test. On April 16th, OpenAI dropped their new reasoning model O3. On April 17th, did your company move faster as a result? Did your automation rate jump? Did productivity increase? How about when Gemini 2.5 dropped, Claude 4.0, OpenAI's new voice model? If not, you're not on the moving walkway, you're dabbling and dawdling." And there's more information. That's the end of the quote. There's more information here. But I think Daniel raises a great point, which is as new AI models drop, a business like Lemonade that's fully leveraging as much as someone who's entirely focused on it as they can, AI, whenever the capabilities of AI shift up, Lemonade's entire capability shaped up too. So they're leveraging the advancements of ChatGPT. So whatever ChatGPT and other AI models were capable of last year, now they've got all the new models from this year, and they've created a leap or a jump effect or a new S curve in the productivity of the team. So however much they were productive in the past, they're more productive in the future. So if you think about it, in 3 years, whatever capabilities all the new AI models have, Lemonade will have those advancements too, because they're basing their whole infrastructure and system and how they code. Now they're like, using coding all through the AI system. Um, they get all those advancements to themselves, while these companies that aren't doing that, that are still relying on human labor, are basically getting farther and farther and farther behind as those who use AI leverage it further. So I thought, that was an excellent point that Daniel made.
Yeah, that goes back to the comment he made about being on that sort of walking, I can't remember what it's called, the walking escalator or whatever that thing is.
Yeah, the ones in the airport.
Yeah.
Yeah, so basically Daniel was referring to when you're at the airport, you've got these kind of walking escalators that move forward so that when you get on it, you can move quicker, right? And then you can just walk instead when you're going down the airport. Now, if the walking escalator goes the same speed, then you're like, well, maybe I can walk. It's not a big deal if I miss out, right? Today, you're like, well, all right, maybe I miss out. I don't know how great this escalator is. I'll just miss out and be a little bit slower. But when you're using AI, that walking escalator keeps getting faster the further in time you move. So maybe it's only at the same pace today as, or let's say 3 years ago, maybe it's at the same pace 3 years ago as a person walking. But then when you fast forward every year, it starts getting faster and faster until a point comes where it's so much faster than the people walking that you could be running at top speed, being the greatest marathon runner of all time, and you won't be able to catch people on that walking escalator at the airport. And that was kind of the analogy Daniel was using.
Yeah, that was a really good analogy. Um, I mean, do you want to jump into the reinsurance update? Or
Sure.
should
Yeah,
you,
let's go.
is there anything else? Sorry, just before we move on, Jake, is there anything else you wanted to add before we sort of moved on? I think we're
Yeah,
just starting.
I don't think people understand how powerful of a tailwind this is. This is like you're sailing across the ocean and there is a powerful wind just blowing you directly where you want to go. And no, everyone else decided, let's not put up sails. And like that's kind of the situation that we're in. And I know that critics will say I'm being too harsh because every AI, every company is using AI now. But I think Daniel did a good job addressing that in his letter as well, talking about how AI is just now a euphemism for anything desirable. And really, it's like it's keeping this pirate ship analogy or this ship analogy going forward. It would be like if other ships, a couple of the crew, like maybe the deck cleaning crew, was like, hey, I made this like little hand sail, and if I hold it up, I think it's helping us move a little faster. And like this is the sort of AI that other companies are trying to implement, while Lemonade has the full mast open and is just flying by all the other ships, because they're actually harnessing this tailwind. So let's talk about this tailwind a little bit. I know you guys mentioned this, but it's like the constant. So have you guys been seeing the like trades happening between like Meta and OpenAI, like Zuckerberg stealing AI researchers from OpenAI, like $100 million with $100 million signing bonuses and stuff? These companies are battling each other, trying to create the best AI LLMs, the best models possible, and they're burning capital, and OpenAI is burning investor funds, like quite literally at billions of dollar run rates of just like setting the money on fire. And all of that work, all of that investor capital, all of Zuckerberg's hard-earned money, it's all being used to make models faster. That is the tailwind that's blowing Lemonade ship faster. Like all of this work from the entire AI industry is literally helping Lemonade have a more effective, fully autonomous organization. And then Lemonade is also doing a lot of very important stuff with specific context training, and training risk models and stuff, which OpenAI and Meta, like their LLMs are never going to be able to run an actual insurance company without this specific stuff. But the general stuff they're working on all helps Lemonade. So I don't know if that was the clearest way that I could have explained it, but it's really exciting what's happening and how much money and work and effort is going into literally making Lemonade better.
Yeah, I do think. Oh, sorry, I was just going to say I do think there's like I said this in the podcast that we had with Amit last week, which is I think there's this like total disbelief that Lemonade has. I'm not sure if it's the infrastructure that they claim to have, or if it's just people doubt the general credibility of Daniel and Shai for a variety of reasons. But it seems like a lot of people are unable to appreciate like the amount of extra operational leverage that you can squeeze out of an infrastructure stack that's been designed from the ground up, front to back, vertically integrated with all of these things in mind from day one. And I don't know that a lot of people will be able to sort of unpack that for themselves in their minds without having some, you know, maybe direct experience working in a large company and sort of seeing these things for themselves, when you've got these very fractured infrastructure stacks, that are, they're patched together through all sorts of like middleware and different things like that. It's just really hard to really take advantage of LLMs in the best way possible when you don't have that sort of infrastructure. Brian, did you want to add something?
Yeah, I think a lot of people generally think in terms of size, but they forget that speed is oftentimes, especially in innovation, speed is more important than size. And all of the companies that we know today, um, you know, many of them, Netflix, Google, they were willing to sell for much less than they're worth today to a bigger company, that had more assets and could have done everything that they did, but they chose not to, or they chose to do it too slow, and they all got disrupted as a result. So I think it's just some people prefer to focus on, I think, the wrong metrics for innovation, because innovation is about speed and how fast you're going more than anything else. And if we go back to companies like Geico, who are saying, as Daniel mentioned in their 10-year note, Geico is their head of insurance at Berkshire Hathaway, which owns Geico, said that they're just dabbling in AI and they're waiting for the opportunity to present itself. In other words, in their view, AI is the escalator, walking escalator at the airport, and it's moving a little bit faster. Right? It's moving fast, in their opinion, at least. It's just moving a little bit faster, and once it's really, really fast, then we'll get on the escalator. But the problem is by the time they get on it, Lemonade is going to be so far ahead, miles and miles in front of them, that no matter how far they run, they'll never catch up to them. And I think that's the main point of innovation is you're looking at speed, and eventually you're just too fast, and nobody will catch up. So
Yeah, and it does make me wonder as well about in the future, because this sort of walking escalator is accelerating as much as it is. Are all these data efforts that incumbent insurers are undertaking even going to help them at that point? Because it's almost like, it goes back to that old adage where, skate to where the puck is going, not to where the puck is. And I feel like a lot of the legacy insurers will get caught up, in this perpetual cycle of trying to skate to where the puck is, just because their infrastructure stacks are just not built for this and they're not sort of future proofed.
yep,
So
and as Daniel said too in the share, or not a share letter, but the 10-year anniversary blog post, which I recommend everyone read. Uh, so oh gosh, sorry, I just lost my train of thought. Um, oh my gosh, I just lost
the
it.
10-year, we were talking about the 10-year letter and also just the data efforts from incumbent
The data
insurers.
efforts. Yeah, yeah.
Right.
So basically, like 69 or 70% of the R&D or the tech spend, I should say tech spend, of the tech spend is to basically maintain legacy tech debt. So all the systems that they have, everything they have, it's not focused. The bulk of it is not focused in R&D. The bulk of it is not focused on figuring out ways to leverage AI. It's just trying to maintain everything. It's like they're in this infrastructure that's decaying, and there's all kinds of different code, and they're just trying to keep the lights on, and that's what 70% of their technology is going to. And of course, when they're just trying to keep the lights on, it's hard to come up with innovative solutions to the business because it has to interact or work with all of this other things that don't work. So it's very hard on legacy businesses to innovate as quickly, and that's why startups and new businesses can overtake legacy businesses when there's S curves in technology because they can move faster.
I just want to butt in here for a second, if that's okay, and just talk
Yeah, go
about
ahead.
Yep.
the stock for a second. So the stock is down, 3.6% right now, almost 4%. And I know a lot of people um who might like Lemonade or might be interested in it. Like this still worries them. It makes them feel like, oh, maybe this is a bad investment. Look, it's down a little bit. Or I should have bought today, not yesterday. I can't believe I'm so dumb. And it's like you just have to calm down and take a deep breath and zoom out a little bit. And you have to know why you purchased stock and why you own it. So for me, as a long-term investor who's planning on holding the stock for the next decade, the next half of Lemonade's life minimum, the daily fluctuations of the stock really don't matter at all. Like I'm looking at this and I just smile because I know what's coming. And when you understand a company better than the market does, like better than 95% of the market participants. And to be completely frank, Daniel has talked about this. A lot of the companies shorting Lemonade don't even know what Lemonade sells. The daily fluctuations, like they just really don't impact you at all. And what Warren Buffett says about how the market is just like your crazy neighbor who comes up to your house, knocks on your door every day and says, this is how much I'm willing to pay for your house today. And like sometimes they're manic, depressed, and they're hardly willing to pay you anything. Sometimes they're just like they're super excited. Maybe they just got their own payday and they're like, I'm willing to pay you twice as much as what your house is actually worth. The actual value of your house is not changing every day based off of the manic depressive opinion of your neighbor knocking on the door. So it's just really, really important when you are thinking about a company that you disconnect the price from the value. And that is how you actually find opportunity. You figure out what the actual value is yourself without any notion of what the price is. And then eventually, after you understand what the fundamental value is based off of your own research, then you look at the price and you see, okay, is the price offering me a deal based on the actual value? And I know that a lot of people think that my models are crazy, but I literally think that Lemonade is worth $190 today. So when I see it at 47, it's a buy. When I see it at 40, it's a buy. It's like it's offering such such a level of safety at the price I'm paying compared to the value that I think Lemonade is worth, that it's just a no-brainer every day. And I don't really care when the market is going to figure it out, to be completely honest. So it's like I tweet about and we talk about Lemonade to educate people because we think it's an exciting company that hopefully more retail investors can benefit off of. But if I went into a coma for the next 10 years and didn't say another thing about Lemonade, it's like I have no worry about this company and about this investment. So that's all I wanted to share.
Yeah, those are great points, Jake. Like when I look at my X feed all the time, I see people like, why is this stock down today? And, to me, stocks go up, stocks go down, and volatility is a feature, not a bug in growth stocks. And the reason why I view that growth stocks and innovative companies tend to have such volatility is, one, there's typically not like a PE ratio or a relevant PE ratio, especially if they're not profitable yet. And analysts love PE ratios because it helps them figure out, okay, this is how much earnings they have, this is how much you can get. Let's look at earnings per share. I can figure out, what is my stock worth? And they look at backward numbers and they can get an idea of what their stock worth because, oh, they have past profits. I can use this to say, over the next 20 years, as long as things don't change, I get my money back based on the PE ratio or whatever. But when you're looking at innovative companies, growth companies, those backward metrics like book value and ROIC, which you can't really calculate if you're not generating profit yet in terms of the traditional way. Those things, they have no relevance on the future because the best profitability is ahead of them, not behind them. So that creates volatility because analysts don't know how to price a company. They don't know, analysts didn't know how to price Amazon. They didn't know how to price Netflix. They never know how to price innovative companies, and they never will, because if you want to, you have to understand the fundamentals. You have to understand things that aren't clear in backward numbers. You have to look at, the quality of the leadership, the quality of the things that they're building. And they can't do that, and they don't know how to do it, and it's uncomfortable for them to do it. They want the safety of numbers. So if you're able to find businesses that you believe are clearly innovative, such as, I believe Lemonade is clearly innovative, then you can take advantage of the volatility when analysts, say, dump the stock. We're scared for XYZ reason, but that they're building something great, and that those things will show up in the future, not in the past.
Yeah, great points. I do think there's a lot of people. I mean, I'm included in this bunch who like to watch markets on a day-to-day basis anyway, sort of following macro trends, following what different stocks are doing. I do enjoy looking at different things like that. So I mean, there's a fascination with the stock price movements and why maybe it's doing what it's doing. But I think ultimately my sentiment goes back to what both you guys are saying as well, which is focus on the longer term, focus on what it is that you're investing for and where you think the value of the business is going. And yeah, I think to Jake, your point, I think to the same point that many others have made, it's so undervalued today, like today, that I'm just not worried. Like in terms of having margin of safety, I've never felt more comfortable, in fact, in a stock that I've owned. And this is over 20 years. So anyway, I think we've done quite a bit of cheerleading now for the first half an hour on the back of the 10-year letter. Wanted to shift gears into the reinsurance announcement. So, Brian, do you want to sort of cover off your thoughts? I know you did a pretty good write-up on it yesterday, sort of going through your initial reaction and then your sort of follow-up reaction to after having digested it. And then also, of course, now that you've seen Daniel come out and say, actually, this entire thing was by design, and we could have renewed our reinsurance under the same exact terms, which, by the way, I think is super, super important, which I'll come back to. But Brian, you want to share your thoughts?
Yeah. So first, for everyone joining us, I'm just going to read the portion, a snippet out of the renewal press release so that everyone knows exactly what we're talking about here. So before I read it, just to cover the bases, reinsurance is basically Lemonade gets insurance for themselves from another company. And, if in a disaster or something happens like the LA fires, the portion that is reinsured, basically the reinsurer covers. So it kind of reduces their risk, but it also kind of reduces the amount of profits that they get to hold for themselves because they're paying for the reinsurance. So that's kind of what it is. This is from the press release and the announcement, and these are their exact words. Given strong progress in the company's diversification, underwriting prowess, and loss ratio trajectory, the company has chosen to reduce the ceded proportion of its quota share reinsurance from approximately 55% to approximately 20%, effective July 1st. So this is already in place now. The variable ceding commission rate related to the quota share agreement is expected to be roughly equivalent to that of the expiring agreements. The program covers all Lemonade business globally, and the primary quota share carriers will remain unchanged. And now that's the end of the quote of the announcement. And then there is a quote from Shai on why they did this. So it says, this year, we continued to reduce our reinsurance overhead, which is a reflection of how much stronger and more precise our tech-based underwriting and pricing machines have become, said Shai Winiger. Reinsurance comes at a cost, and thanks to years of steady improvements, we're now in a position to retain more of the risk ourselves, improve margins, and stay capital light, all while continuing to work with some of the world's top reinsurers. And that's end quote. So that's basically the news and what happened. And then, like Neil said, on top of that, Daniel said that they're not they didn't reduce reinsurance because it was going to be more expensive and the market was harder. They reduced it because it was their choice to do so. They could have renewed it at basically the same terms that they did before. So this was totally their direction, which kind of matches what was going on in the reinsurance market because news that I read have reported that the reinsurance market is about the same as it was before the LA fires. It wasn't any harder.
Brian, you mind if I just add a little bit of context here?
Yep, go ahead.
Yeah, so I think the thing that people need to remember about reinsurance is that if you have a business that's totally reliant on reinsurance, that does present a risk to your business. And for those of you who've maybe had an opportunity to watch the interview I had with Daniel, you'll sort of hear him talk about their reinsurance strategy. So if you think about a new startup insurance company, they're going to heavily rely on reinsurance because they don't have a large enough capital base necessarily to be able to insure all the risks they're taking on. So in order to, further leverage the capital that they have on hand, they're going to go out and get reinsurance partners to sort of help them offload some of their risk so they can continue their data collection efforts and sort of, refine their algorithms and do what they need to do. So there was a lot of concern when Lemonade first started, particularly from ARK Invest, that they were too reliant on reinsurance, and that if reinsurance were pulled from the business, and this has actually happened to another one of the insurtechs, I think it was Hippo. I'm not exactly sure about that. I need to double check. But if your reinsurance partner essentially says, actually, the risk that you're underwriting on your book makes us uncomfortable, they can tell that insurer that they no longer want to be their reinsurer. And that does present a big risk to a small growing business, or it could present a big risk to that small growing business. So there was this general concern that this is something that could happen for Lemonade. Now, if we sort of go back, I think 1 or 2 years, Lemonade originally had 75% quota share, if I'm not mistaken, and then they had dropped that down to 55%. Now, there was some thought from short sellers, maybe bear skeptics, that they had reduced that amount of reinsurance because the reinsurers weren't happy with the business that they were taking on, and so they had to reduce it. But in fact, as it turns out, this was more about a show of confidence from the business that, hey, we're more comfortable underwriting our own business, taking on that risk on our own books, and sort of going from there. And so now, when we look at reinsurance and we see that the announcement came out and they're dropping it from 55 to 20%, I think that there was some concern, and I saw this from a number of people that, and I think it was a justified concern, but there was some concern that they were dropping that reinsurance not out of their own sort of election, and that they were being maybe potentially forced to do so because of higher prices, or because the reinsurers didn't like the risk they were taking on. And so they had no choice but to take on some of that risk onto their books. And this is why it was so important to get this clarification from Daniel, for him to come out and say, actually, this thing was entirely by design that we reduce our reliance on reinsurance. And, and it goes back to the quotes that Shai made in the letter that, hey, because of, the progress we've made on loss ratios and automation and so on and so forth, that we feel very comfortable reducing this reinsurance quota share from 55 to 20%. And I think a lot of this comes back down to, and I mentioned this in a few comments and replies, a lot of this comes down to portfolio optimization. So if you think about Lemonade's entire book of business, one of the things we learned about a year and a half ago was that some of their home policies were mispriced. And so they had to sort of take a lot of those policies off their book, because non-renew those customers, because it was adding a lot of volatility. They were overly exposed to some of these cat events, and they just didn't like that uncertainty that it gave to their entire sort of book of business. And so they've made a lot of efforts over the last 18 months, maybe 2 years now, to non-renew a lot of those home customers. I think this has been a huge part of why we saw the guidance for 2024 not coming as strong as we wanted, because it accounted for some of those non-renewals. And then they also talked about how they were going to put a lot of the policies they had, I don't want to say a lot, but they were going to put some of the policies they had on their books onto other carriers' paper. So what that effectively does is it offloads the risk from their own balance sheet and puts it onto another underwriter's carrier, another underwriter's paper, but allows them to maintain that relationship with the client. So when you non-renew customers, when you then take other home customers and you put them onto other underwriters' paper, you're effectively reducing a lot of that balance sheet risk to yourself, and you're also freeing up a lot of risk-based capital. So I think these are like two things that maybe a lot of people weren't aware to what extent they were working on it. But for me, this has always been a very important part of the business, and I do think that portfolio optimization is going to continue being a thing for them, like sort of looking out into the future. Because ultimately, I remember, actually, I want to ask Daniel this question, because there was a time when Daniel had said that even if the customer's LTV to CAC is slightly above 1, that's a relationship that we want to maintain. And I kind of wonder now if that strategy has shifted a bit, where now that they know they've got, such great loss ratios, and they know they want to accelerate growth the way that they're talking about, it does make me wonder, has that strategy sort of shifted a little bit, where now they're not just thinking about if the LTV to CAC is above 1, but they're actually looking at, like, what's the risk, what's the utilization of risk-based capital that we're taking on from each policy dollar that we're taking on. I don't know if that makes sense, but it's effectively trying to maximize every dollar of capital that you have to facilitate your growth and try to minimize the number of risk-based dollars that you're using. I know, Brian, does that sort of make sense to you?
Yeah, I think we could do a whole episode on just LTV to CAC, because that's an area
Yeah, fair enough.
that confuses people. But yeah, so for reinsurance, I think risk-based capital. It's important to note that Lemonade, they have to have money in reserve for paying out claims, and generally speaking, an insurance business, it needs to maintain at least 200% of whatever their risk-based capital number is. And if it goes under that, then regulators can kind of be like, hey, we don't think you're well capitalized. You need to get your numbers up, or we need to figure some things out. They'll send you a letter or something, and things will happen. Lemonade right now is at 580 to 600% of their RBC. So they're very well capitalized. And the more reinsurance you have, the kind of the less total amount of money you need in reserve, because your reinsurer will help. Basically, if there's disasters and things, they help. So it uses their capital, not your capital. So when more of the risk is on your capital instead of reinsurers, then you have to, have more capital on your end. But because Lemonade is already so high, like 580, 600% or so, reducing reinsurance is not a problem really for their risk-based capital. So that's one of the things that investors should know when the reinsurance amount changes. Like, how does that change the amount of ratio that they decide to hold in order to pay for claims, and how much reserve do they have? because that reserve also pays for other things too. So, the more they grow and the more they expand the business to, the more risk-based capital they need.
Yeah, no,
So.
I think that's a fair point. Sometimes I forget that we're sort of very into this stuff, and I might use terminology that people are not necessarily familiar with. Yeah, maybe we should actually think about like having episodes sort of dedicated to certain topics, and we cover that off for like the first 30 minutes and then do Q&A for the last 30 minutes. But yeah, we'll talk about that offline, I guess. Is there anything else I mean, I'm just trying to think about, there's so many different aspects of this reinsurance announcement that I want to talk about.
Do you mind if I jump in for a second here on
Yeah, please
reinsurance?
feel free.
Yeah, so I think that one thing that I was reading a lot of analyst updates and stuff like this, and one thing that people are not getting is that Lemonade didn't 100% remove reinsurance. Like I was reading one analyst take, and they were like, Daniel and Shai are risking their entire careers on this move, and it's like, okay, calm down for a second. When Lemonade is very small, not in very many states, not with very many products, a massive cat event, a massive disaster event can be very detrimental to their book, especially if it's concentrated in a single geographic area, something like that. Now Lemonade has grown up a lot, right? They're 10 years old. They're in multiple different countries. They're across almost every single state in the US with one product or another. Their book is diversified across renters, pet, home, car. So a single disaster event in, say, California, for example, it's no longer close to an existential risk to Lemonade, just for one. So reinsurance is not necessary in the sense that if something, if a 1 in 100 year event happens, they're not capitalized enough to be able to pay it out and continue. So I just really don't think there's any existential risks in that sense. But then another way that you can think about it, if an analogy is helpful here, is that Lemonade is trying to create a pro bowling team, and you can think of like getting a perfect strike as like perfectly underwriting the risk and charging a premium where you're going to have solid loss ratios like in the 70% range. And Lemonade has gone from most of their team members, and then if you think of each team member on the bowling team is a different product. So like one team member's pet insurance, one team member's home insurance, one team member's renters insurance. They've gotten to a point where now pretty much every single team member, car is getting better, but pretty much every single team member, especially renters, especially pet, they're just bowling those strikes over and over and over again. So Lemonade has the ability to remove the gutter walls, which is the reinsurance. So when they're small, they're all learning, it's their first day at the bowling alley. It makes a lot of sense to pay a little bit extra and get those gutter walls up so that you can bowl. And if your underwriting's not quite right, if you can't quite throw straight, the gutter will save you, and you're not going to be in a bad situation. But now they've been bowling for 10 years. Every single throw now is going straight down the middle of the lane and getting a perfect strike. And they want to not only join the professional leagues, they want to become the best bowler in the world. But it doesn't matter how many strikes they're throwing. When they still have those gutter walls up, everyone laughs at them. Everyone's snickering behind their back. Like these guys think they're going to be pro bowlers and they're still using gutter walls. So you get to a stage where eventually you have to take the gutter walls down, but they can do it in an intelligent way where they're just removing the gutter walls first, from the 80% of the team members that they are most confident in, that are just so consistently throwing those strikes with great underwriting, great loss ratios, no existential risk to big cat events. And all of a sudden, like this is Lemonade growing up. All of a sudden, the respect that you're going to see from the rest of the industry, when Lemonade's margins are getting better, when they flip to profitability, when they have these incredible loss ratios, when their combined ratio starts getting best in industry, and they don't have gutter walls up, they're going to be accepted into the big leagues in a brand new way that is not possible when you're bowling with gutter walls up. Is that helpful? And then um, the other thing that I think is big as far as reducing risk for Lemonade is if the stock actually gets bid up to closer to fair value, which I think is around $190. Lemonade doesn't need to raise capital, but at that point, I think once you're at fair value, it makes a lot of sense to raise capital because then you can accelerate growth to a whole nother stratosphere. Well, what has a better chance of making low effort retail investors? I know most of you guys here in this call are not low effort. You guys do a lot of due diligence. You guys are truly smart money. I think even smarter than the smart money on Wall Street. Some of you with the hours and hours of research that you do on these companies. But when general retail traders are going to be able to look and see this insane revenue growth because all of a sudden Lemonade is claiming more of this IFP that they're not reinsuring as GAAP revenue. It makes the company look a lot more attractive. Like after Neil, we did our presentation with Amit. The next day, he had his friend Steve on, and Steve was just ragging on Lemonade and being like, look how little their revenue grew quarter over quarter. It's like, that is going to flip. Like for people that don't understand anything, they're going to look at Lemonade and they're going to be like, oh my gosh, what a fast growing company, even though IFP continues growing at the same rate. So traders are going to be a lot more excited. Honestly, Wall Street, which is not as smart money as they would like you to have, is going to start being way more excited. And then the industry is going to be respecting them because there's no more gutter walls on their bulls. So their strikes actually matter. But that's kind of my take.
No, I think that's a good analogy, gutter walls, right? Because they are bowling strikes essentially right now. But like you said, they've got the gutter walls up, and I think a lot of people can't appreciate the business for what it is because of that. And I think you're spot on with that analogy. Domian, I just brought Domian up as a speaker. Sorry, before I get to Domian, Brian, is there anything else you want to add here? I mean, there's a lot we can cover off on the reinsurance thing, and I'd love to get into it. Please go ahead.
Yeah. So one thing I want to talk about with reinsurance is first, for those who are thinking about hurricane season, because it's coming up, hurricanes were already excluded from reinsurance. And the reason being is Daniel previously said, like, if you had like, the most apocalyptic, worst season ever, that was like just extremely devastating. It's the same as about like 5 years of 5 years of reinsurance basically covers like all of the worst that could happen. So from a numbers perspective, it doesn't make sense for reinsurance for them to pay the hurricane reinsurance. So reinsurance for hurricanes has actually been excluded over the past year. So this changes nothing about hurricane season. That wasn't true last year already. And it just doesn't make sense from the numbers side for them to pay for hurricane reinsurance. The second thing I wanted to talk about was, well, what does that leave? What's actually changing? And, that's kind of like hail events and these, windstorms and things like that, tornadoes, all this other stuff, plus fires. And, we just saw the LA fires, this January. And I'm reading here from insure.com, and this was published like toward the end of March, that the Palisades and Eaton fires is the number one, like in U.S. history, modern history, insurance damage fires, and they had it at like 28 billion. I'm not sure exactly how accurate insure.com is and up to date here, but they have it at like 28 billion for that time period. And the second most was the Camp Fire in California on 2018, which they had at 12.5 billion. So you're talking about well over double the last most expensive insurance fire. And, Lemonade insured homes in California. So they already went through kind of like one of the worst, literally like the worst fire event in the history in the US. And, they were fine. And you had analysts and everyone else who was like estimating like, oh my gosh, like it would be like 200 million in damages or something. And for Lemonade, it was actually like 20 million after reinsurance and something like 40 million or so if they didn't have insurance, pre-insurance. So, they already knew what to expect and they already went through the worst of the worst. And I think that going through the last 10 years, they've gone through a fair amount of disasters and catastrophes. And in housing, we had some of the worst cat events in history. I think it was like in 2022, 2023 kind of period, from a historical perspective, that they kind of gone through the worst and they kind of know what to expect. So I think that brings them confidence that they do feel that, all right, we don't really need reinsurance as much as we thought we might have before, and plus the business is growing after going through that. So yeah, I mean, what's worse? You could have 5 of the worst fires in the history of the world happen this year. I mean, sure, that's possible. But from a reinsurance perspective, I think Lemonade has all of the information that they need to reduce reinsurance at this point. And as Jake said, I think it's time. I like the bullying analogy. I think it's time to remove the bumpers because I think they are throwing the strikes now.
Yeah, well said. And I would say over the past year, like, the hurricane reinsurance exclusion was one area of concern that I had. And I remember I even asked this question to Daniel when I spoke to him, and just sort of reiterating what you said. Yeah, going back to his comments, he did say we can survive pretty much anything, and it would take some cataclysmic event to really wipe out the company, or even maybe not even wipe out the company or make them insolvent or whatever. But that gave me a lot of reassurance. And then watching them go through both of these sort of events, right? There was that hurricane. I can't remember the name of the hurricane now, but that happened over last summer, or the tail end of last summer. And I think it was Milton. And they came out absolutely fine. They were totally unscathed. And then now seeing what happened with the California wildfires, and okay, yeah, they took a $20 million EBITDA hit, but they pretty much can make that up in a quarter now at this point. So, I think seeing them come through both of these disasters and come out better for it, it does give me even more reassurance that everything that Daniel said to me about, they're a lot more conservative with their underwriting, and that we have a lot less exposure to these things that, people might estimate. I put a lot more faith in those comments now. So that's been very reassuring to see. And that gives me a lot of confidence as well with this sort of year going forward, right? Like, yeah, sure. We've got another hurricane season coming up, but I'm going to believe that, again, they've been conservative with their underwriting. They don't have that much exposure. Of course, they could always take a hit. That's just the business of insurance. But, I'm always expecting them to sort of fare quite well coming out of some of these disasters. I mean, of course, I don't want to say that with too much certainty, but I think they'll always be okay at this point. That being said, Jake, Brian, is there anything else you want to? Okay, I see. Domin, you've got your hand up. Why don't you go ahead?
Hi. Yeah, I missed the first half hour of the space, so I hope I didn't miss the discussion on this yet. But I had a question for Jake regarding his bowling analogy. So it sounded like you were saying that they were taking the gutter walls down for certain product lines, but not all product lines, so just maybe the best performant ones. But I was at first glance under the impression that the reinsurance agreement covers the entire book, or at least, well, 20% of the entire book. So I was just wondering whether I understood what you were saying correctly, and whether that's actually the case, that they're dropping reinsurance for some products, but not all, instead of just 20% of the entire book that is covered by reinsurance.
Yeah, so it's definitely not general, like a general broad strokes. It's very specific. We are going to have to wait for the Q2 earnings call, and I'm sure that management will give us a lot more insight in their 20% reinsurance strategy. But I am sure they're reinsuring what they feel is most necessary. Brian, you wanna add on here? You might be able to add like more specificity into that answer.
Yeah, I think we'll have to wait until the call for them to, release the details of everything. I'm not a reinsurance expert, and I kind of take it for granted that, they've been doing 55% for a while, and now they're reducing it to 20%. And again, the biggest context for me is Lemonade's not actively, they've got a decent sized home book. So, they want to manage risk, especially in home. But I see with pet and renters, reinsurance, that's where they've been growing policies extremely fast over like the past 2 years. And reinsurance, in my view, is not really as necessary in those lines as it would be for home.
Okay,
Guys, If I could jump in, I think it's very unlikely that the reinsurance market would accept a non-proportional treaty. That is what the quota share treaty means, is that you have a flat percentage across all product lines. You can have a bespoke product where you have varying lines varying percentages by line, but it's not very common. And the reinsurers would really not want it at all. I think it's most likely that it is a flat 20% across all products.
Yeah,
Josh, also, I got a question while we have you here. Are you aware of like any pet insurers that, of Lemonade scale or bigger that actually use reinsurance?
Reinsurance is very common. Like most companies do use it. I don't know why. For some reason, I think because Ark Invest made comments around it back in the day, Lemonade kind of got a bad rep for having a good bit of reinsurance, but it's very common. So I would expect there to be, but I don't know off the top of my head.
All right.
I missed the first 45 minutes, so I won't jump in with any thoughts, but if you want to bring me into anything, then I'm here.
Appreciate it, Josh.
Josh, what were your thoughts on the back of the while you're here, right? Let's get your thoughts. What was your take on the reinsurance announcement?
I'm a bit mixed because I personally think that there is a lot to be said for the commissions, where you've got good cash flow. We don't know what the commission rate is, but let's say the commission was 30%. If you could scale a book on a capital light basis and get the commissions, I think that's quite a good thing as well. So I see it both ways. But with that said, obviously, if you've got very profitable business, like the pet and renters business especially, and you know if management know it's going to run at 65%, and they want that cash flow to drop straight to the bottom line, then clearly that is a very positive and bullish thing. But I do think we should be aware that the commissions are, a really good part of the financial story so far. So it's not like a straight win. There is a big offset, obviously, from losing that commission. But yeah, overall, very, very positive.
One would imagine they've run the numbers though, right? To make sure that the ROI they're expecting from the reduction in seating is going to be equivalent, right?
Yeah, of course, right? But just looking at it from a return on capital basis, you're obviously the absolute dollar number is going to increase, right? If you're retaining profitable business and the commission rate wouldn't have made up for that, then yes, in absolute terms, you're going to see more income dropping to the bottom line. But the denominator is also going to change because the capital basis would have to change, especially for that bit of business where it's home and motor. You will have some quite significant capital requirements for those two lines. But I think my gut feeling is that the guys are, without telling the investment market explicitly, I think they are kind of hiding the home and just shrinking away from it without really telling anyone. And the car as well, my own perspective is that they are going to grow that more slowly than most people on this call would expect. My own view is that that's going to be quite a slow process. So yeah, overall, it's a very good thing, I think.
Josh, do you care to make a prediction on what they will do next year? Will they give up the percentage again on the reinsurance, or keep it at 20% or below once car has been ramped up a bit?
It's hard to say. I think we could see maybe a couple of years at the current basis. And I think, as I say, the guys will push pet and renters, try and make that a really big book of business, keep all of that cash flow. And then I think, yeah, as you say, as car ramps up, I wouldn't be too surprised if we were to edge back up on the ceded percentage. Because I think, again, there will, unless there's a capital raise, if the guys were to ramp car up significantly on the current basis and home, I think that would be a bit tricky on a capital basis. So hard to say. I think it's unlikely that they'd go under 20% because the relationships they have with those reinsurers are very important to the company, and it's quite prestigious as well to have some big brand heavyweight reinsurers behind you. So yeah.
Do you have any opinion on how GAAP revenue growth is going to look going forward with 35% less of their premiums reinsured?
Yeah, so I did a calculation for the net written premium, and it would be very. I might do it later. I didn't have time, but it'd be simple to add in the kind of approximation for the seeded, so we could estimate it relatively accurately. You might have seen I posted on the revenue piece, and to get the commissions, you would just so the difference between the before and after is the change in seeded premium, and then you would just use an assumption for the seeded commission, right? And you could get that from, let's say, a Q4 24 earnings report, where you just look at the seeding commission divided by the gross written premium versus net, and so on. You could layer that in, right? So yeah, it's relatively straightforward. I haven't done all that work, so I just didn't have time.
But the net result, I would assume, would be, you know, if you have a great quarter where loss ratios are down, like a year from now, you know, that means their cash flow is going to be quite a bit higher.
Yeah, agreed,
So,
right? So yeah, I should say, to do it properly, you would want to you would have to guess a loss ratio. Personally, I know Paperbag has a great set of modelling and so on. Because I have worked as an actuary in the past, I feel like I have. There are some statutory laws about me publishing what could be seen as actuarial work in the public space. So I'm hesitant to make predictions about like future modelling in the same way Paperbag has, just because I have those professional qualifications as well to think about. So I haven't gone that far. But yeah, you would do that.
yeah, but I mean, basically, at the end of the day, we're looking at like a multiplier effect where, you know, if things are good, that means more profit for them. If things are bad, that means you know, more losses for them. And you know, as investors, you got to weigh the two. And of course, on our end, you know, what I look at is I look at, you know, their gross loss ratio, the way it's trending, and to me, it looks very good. So it makes sense why they're doing exactly what they're doing.
Yeah, definitely. And you could do a scenario test, right? So you could probably estimate the commission quite accurately just using published information from prior quarters. You could use a range of loss ratios, and you could come up with a bunch of scenarios. And I think, you know, I'm not going to do it, as I say, because of my professional qualifications and so on. But I think you could come up with a pretty good scenario test where you could guess relatively accurately what set of probabilities would this change be a net positive. And I think, in my guess is it'd be in the 80s, like, you know, maybe 20% chance in a given year we come out worse. You know, 80% of the time we're probably going to end up with way more income to the bottom line, is my guess.
Yep. And at the end of the day, I mean, the ones doing the forecasting here officially is going to be Lemonade, and we're going to see very soon in the next 30 days or so. They don't have their official announcement, I believe, yet on the next earnings report or call. But in about 30 days, we're going to see what their guidance is for the next quarter and for the rest of the year. So we'll see, you know, what they think, you know, that affects their adjusted EBITDA and their EBITDA and bottom line.
I was thinking about that, and it did occur to me, like, to what extent had they already planned a bit of this? You know, because they must have sat down at the start of the year and said, look, what should we do in July? Shall we move the reinsurance? You know, they must have been thinking about it at that point. So we don't know how much of it is already in the guidance. But yeah, you would think it would go up,
Yeah.
right?
I posted a meme
I'm not jealous of being I'm not jealous of Tim Bixby and being a CFO, because that's so much work to redo your entire guide based on the reinsurance change. Sorry, go ahead, Jake.
I was just gonna say, do you guys see that meme of like he must be thinking about other girls, and then It's like if Lemonade grows in-force premium by 30% a year, but slowly reduces reinsurance, revenue growth could actually be 45% a year. Shy liked that tweet several months ago, so they definitely were thinking about this. And I'm just really curious. I know they guide to in-force premium, and that's likely not going to change in the Q2 update. Being slightly under 30% for this whole year, and then north of 30% for next year. But analysts, they tend to predict revenue. Like they're going GAAP revenue, GAAP net income, is what they focus on. So we're about to see a massive adjustment in GAAP revenue, because we're going to be adding on the in-force premiums that were ceded. Now we do back out that ceding commission, but that is probably going to be like at least an additional like 25-30 million of IFP counted as revenue on top of the 30% IFP growth. So I think that analysts are going to have to greatly increase their expected revenue projections for this year, regardless of if we run into the 80% scenario where it also means more profit, or the 20% scenario where it means slightly less profit. Is that kind of an accurate thought on this?
Jake, I think the algos are going to go crazy, because the first thing they do is, the algos are scanning the numbers, looking at guidance, looking at revenue, and all of a sudden they're going to see the full year 25 numbers change dramatically, as well as the Q3 versus their expectations based on this reinsurance change. So I think there's potential like that something is going to happen after they release their guidance. I don't want to speculate too much, but it could be very exciting just to see what the reaction is, because I don't think this reinsurance news, the bots, the algos, they don't know anything. They've already proven that they don't really know very much about Lemonade already, looking backward. So we're all here and we're talking, and we know what the reinsurance means for potential changes in guidance. But yeah, I mean, these bots are, they're just looking at numbers, and they see the numbers change, and they're like going to be like, oh shit, we didn't calculate this at all.
Just to push back very quickly, you might have seen also, I did put out a post on the mechanics of how you would look at the earnings coming through. And as I mentioned to a couple of people online, like, it's not a straight, as you guys know, it's not a straight, flip a switch and suddenly we count all of that seeded change. It does take time to earn through. So my quick kind of estimate was about 75 million of net earned premium change for this year. Obviously, there'd be a very significant offset in the ceded commission. I think where it really will come into play is for next year. So when we get the Q4 25 earnings reports, and we get a full year 26 guidance, then we will see a really, really big change. So I think the Q4 earnings report, just on that revenue guide, will be very significant, but not so much for this second half of this year. I see Preston has his hand up.
Yeah, Preston, go ahead.
Hey, Josh. Josh kind of just talked about what I was going to touch on. Is like, I'm not expecting, at least initially, that the Q4 letter will necessarily. I mean, I expect them to update guidance, but my understanding, like based off of like U.S. GAAP rules, is that they can't count premiums that were written before the new reinsurance agreement went into effect. They can't count that as revenue. It's still under the 55% seeding rule. So that will be like one thing to. I mean, maybe I have a misunderstanding of it, but that is how I believe they're going to have to recognize it. So kind of like Josh was saying, I think 2026 guide will be very interesting, given the reduction in seeding.
Yeah, that's definitely right. It would be the net earned premium, which anything written prior to 1st of July 25 would not have any impact at all on the net earned premium.
So this is even if like a customer is paying monthly and then now this month their payment is not reinsured anymore. Lemonade still cannot count old books, new payments that are no longer reinsured. Am I understanding right?
I believe so. So, like for instance, like car policies are typically written in 6 month terms. So if you wrote a policy, let's say in March, and it gets renewed in September, they so for the first 3 months of the new reinsurance agreement, they will still be subject to the 55% seating, but then once it gets the car policy or whatever policy they're writing gets rewritten again, then it will come back down to the 20%, like based off of the new updated agreement. So I don't have like exact numbers on like what I'm expecting yet, like in terms of like revenue for the rest of the year, but I do think it may not be quite as dramatic as what at least I initially thought. So if anything, it might be an opportunity to potentially accumulate more shares because as everyone's kind of touching on, analysts, they like to look at
Okay.
the surface,
So
but
the agreements are not being
I,
renewed, but they fall off slowly. That's kind of what I'm understanding. The reinsurance falls off over time.
that's my understanding of it. Yes.
Okay. Understand.
I think I'm not 100% certain on when it could be a monthly policy, but the reinsurance agreements would definitely anchor to the written date. So if you had let's say you had a home policy payable once per year and it was written on the 1st of March, you would, I think that would still anchor to the old reinsurance treaty, as far as I know. But I think without getting too deep into the weeds, suffice to say that it will take some time to earn through. Like it won't be an immediate change.
yeah, I mean, thanks for the context, Preston. A lot of this, it does have to work through the, the financials, the cash flow statement, all the things, locked up, seating commission, et cetera, et cetera. But the ball is kind of in Shy and Daniel's court in what they want to put into their next quarterly report and the next call. And, although it does take time for some of these things to filter through, they can, put out some very impressive numbers that, all right, what if it didn't filter through? What if there wasn't any filter through? What would last year's revenue have been and profit had been if they had this new agreement in place last year or the year before, et cetera, et cetera. And I think it's kind of up to them where they can frame their profitability again to analysts and investors of, this is where we would be at. And then they'll, still provide, all right, this is whatever the gap requirements are, which again, I don't know 100% exactly how all this filters through. It will take quite some time to go through, their cash flow statement, their net income statement, everything, and figure out line by line how everything's being
Yeah,
affected.
I did think of something else. If you can hear me, I'm currently maybe losing connection, but can someone confirm that they hear me?
Yeah, we can hear you.
Yep, we hear you.
Yeah, I seem to
But
remember an appendix in one of the shareholder letters last year that said that the ceding commission was actually not a fixed percentage, but it was dependent on the loss ratio, such that if the loss ratio comes down, the ceding commission increases. So that would make it even more remarkable that they decide to take on less reinsurance now because the loss ratio has come down, which means on the terms of last year's agreement, the ceding commission would be higher now than it was last year. So given that they still choose to wind down on the reinsurance, that's very remarkable, I think. But I'm not sure about this. I need to check
Yeah, that
the
is
letter from
correct
last
for sure. That is correct.
Yeah, that was another thing I was going to say, which is the fact that last quarter they were able to report that 59% gross loss ratio, ex cat, of course. I when I heard that headline figure, I was very sort of wowed by it because I think it's the first time we've seen it that low, and the fact that they've gotten it so low definitely means that they're able to sort of now do what they're doing with reinsurance. I'm going to be very curious to see what that number comes in this quarter, because if the trend continues, that may even come in. I don't want to sort of say, set expectations wrong here, but it could come in potentially even lower than that. And without any sort of major catastrophes this quarter, we could see a huge sort of dip back down in that gross loss ratio. But I think that could also be offset by if they are pursuing growth more aggressively, like they're happy to, if that number ticks back up a little bit, as long as it stays within a certain range.
Yeah. Preston, you had your hand up.
Oh, is it still up? I meant to take it down.
Oh, okay. All right. Well, I know reinsurance is a very important topic, so I don't want to move on if there's still questions or comments. Does anyone still have anything extra they'd like to add?
I have another question for Dividend Stream. Just overall, this is a move that was going to happen at some point, right? Like, this is just part of aging as an insurance company, and a good lens to look at this through is simply that Lemonade is growing up. No.
Josh, I think
You're on mute, Josh,
yeah, I think that
by the
question.
way.
Sorry, that was that for me. Yeah, I think so. I'm surprised how quickly it happened. I would have expected it to be like a 10% each year kind of move, which would have aligned better with the history of how the guys have run the company. It's very slow and steady and very cautious. So yeah, I guess it was inevitable in a sense. But on the other hand, you could also make a really good case for if the guys get the tech right and get the underwriting in line and everything set up well, they could just go to the capital markets and say, look, guys, we've got a really great platform. We've got a good connection with all these customers. Who wants to get on board and be a partner, right? And then just essentially become more like a broker, let all that premium flow through, and someone else provide the capital. So you could see it both ways. But it looks like this is the way that the guys have chosen to go. And yeah, it could have gone both ways, to be honest.
So this does go back to something else that we talked about earlier in the call, which is the fact that their business is advancing sort of at the pace of the way LLMs are advancing. And, if we go back to the 10-year anniversary letter where Daniel talked about, if your business didn't improve when ChatGPT released their latest model, then you're just dabbling. And, I have to wonder, like, to what extent the advancements in AI and LLMs have allowed them to also bring down this reinsurance to the extent that they have, because of how much more efficiency they might be getting. I can't remember the exact statistic, but I remember Shai published it not long ago where he talked about how many of their customer tickets were being completely managed by AI. And I wonder if there's been like a significant markup in that number as well. That's allowed him to do this. I don't know if anybody has any thoughts on there, but Brian, is there anything else you want to add before we sort of move on to the next topic? Do you have something in mind that you wanted to cover?
In the absence of anything else, I was thinking about covering the marketing campaign and Lemonade as from a marketing level overall.
Yeah, well, yeah, let's move on to that. I think we've sort of talked about reinsurance quite a bit. Do you want to sort of set the space?
All right, great. Well, yeah. First, thanks to Josh, Domian, and Preston for all the added context and expertise on the reinsurance update that you've been following. So for marketing, we just saw a recent campaign. There's some bus stops, and they had very, very, very nicely marketed bus stops and things. And what it got me thinking about again is just how good I view Lemonade overall in marketing. And I don't want to pick on Root, but I'm going to, because they're kind of launched around the same time as Lemonade, and they're kind of a startup insurtech. But if you go to like Root's website, they're using like a 6-year-old model of an iPhone. And go ahead, like while you're here, go to like root.com, and there's their website. They show an orange screen of a really old iPhone with an R on it. That is the brand that they are presenting to the world. And then it's 2 pictures below that of their phone with like this is what our app is. It's got some stuff, and that's their brand. And it's like, what does that even mean? Like, it's just, it feels very generic. It's like, what is the purpose of this company? How do you feel when you look at that? And is this a memorable brand? And I think a lot of companies, they don't get branding, and they might be rude, that are smaller companies. However, in insurance, branding can be a big deal. Like, one of the things that was huge for Geico is they had the "So Easy a Caveman Can Do It" kind of campaign. I think that was in like the 2000s, and that was huge for them. It resonated with customers. It was very memorable, and they had very good returns on marketing back then. And I think Lemonade is like Geico quality, and for their size, they are so, relative to where Geico was back then and where they are today. For their size, Lemonade is punching way above its weight in marketing. Um, their whole brand is different. It's memorable, and it's got the pink kind of logo, friendly logo. It stands out, and it looks like, reinsurance you typically associate with not being fun, with being kind of like an unloved market. But Lemonade really does a great job at marketing himself and showing, we're friendly and we're here for you, and we're a likable insurance company, and we do things different, which they actually back up by doing things like paying claims in a few seconds, while other people take a lot longer to do it. And we see marketing campaigns from Lemonade, like on their YouTube page. They have tons and tons of ads on there. Many of them are really great, and uh, they've got millions and millions of views. So they're definitely advertising and ramping up ad campaigns. And I think it's important to see that Lemonade is iterating and doing a lot of work here, because creating effective marketing campaigns and creating a brand is hard, and it takes time, and the results are not immediately clear. Right away. It has to be done over time, and built up. And I think Lemonade is really built up their engine for marketing, and that's why they're able to scale so many different policies and have good returns on their CAC. Is yes, the pricing is good, which is one of the most important things in insurance, but also the marketing is catchy, and more likely to convert. So I don't know. I just want to open it up. Those are my thoughts. I want to open up to everyone else. Like, what do you think of Lemonade as a brand and as their marketing versus companies that are only 3 billion market cap size?
Yeah, so that's a good question. I haven't, to be honest with you, looked at a lot of the other insurtechs and their marketing, but I'm looking at Root's homepage now, and yeah, they don't really have like a sort of playful, fun brand. It certainly doesn't look that way. Um, but yeah, I am always sort of thinking about the Geico Gecko. That I think is such an iconic brand, right? And I think Lemonade is definitely doing a good job, punching above their weight. I definitely agree with you there. I love their ad
Yeah,
campaigns as well. Sorry, go ahead, Jake.
No, I can let you finish, but if you're done, then I was just looking at Lemonade's homepage, and it is so fun. It's literally animated, but it's animated in a cool. If you just go to lemonade.com, you can see what I'm talking about. But it's animated in this cool, like, stick figure-esque style. The car is moving. It's an electric car plugged into the house. The dog's wagging its tail. Someone's bopping their head to beats. It just feels so friendly. It feels simple. So it I don't know. It's like the opposite of intimidating, and I think that's really what they're going for. Because insurance can be thought of as a kind of intimidating, not fun thing. Oh, I just noticed, like, the cat in the door on the house on the left wagging its tail as well. A bird just flew onto the house onto the right. It's just, I don't know. It feels so friendly and happy. And then even you scroll down, and Lemonade is 4.9 stars on the App Store, while Root's only 4.7. Now, that said, I actually think Root is also undervalued. And I think they're going with a little bit of a different strategy, trying to do partnerships rather than direct advertising in order to acquire customers, which I think requires a little bit less of a real lovable brand, like Lemonade needs when it's direct to consumer. But yeah, I think you look, just confirming everything that was just said by Brian and Neill. You look at the advertising that Lemonade's putting out there, and it is really high quality. Like, they are punching above their weight, in a way that even if they didn't have the AI advantages, even if they didn't have the underwriting advantages, I think they're building, the automation, the expense ratio advantages, I think that they're building. I really think just their brand could probably bring them into a mid-sized insurance company, which
It's
would be a 10x, 20x.
yeah, it's like good vibes when you go to their site. Like you feel good, and it's like, what insurance company makes you feel good when you go to their website? Like, you know, you go to some other websites like Root, and you just feel like, oh man, this does not look like it fun. I got to sign up through everything. But you go to Lemonade, and you're like, oh, I'm kind of in a good mood just looking at their website, right?
Yeah, and then the actual art, if you guys have not seen the bus stop art pieces, let me see if I can share it underneath here. It's really cool. I'm guessing everyone in this call, because we're all obsessed with Lemonade, has seen it. But it I made the comment that Chicago should be paying Lemonade for these art pieces because the city has never looked so good.
Yeah, yeah. Yeah, I love the bus installations that they did. It stands out, and it's not like I see a lot of terrible billboards and ads by different companies, and like they don't make the branding clear. They don't make it clear what it is about. They don't make it clear who the brand is. It's like, here's an interesting picture, and then like their logo is in like the bottom right corner or something. Whereas here was Lemonade, you're like, whoa, what the heck is that big pet statue on the top of this bus stop? Or you know, it draws your attention to it, and then you see the whole thing about Lemonade and getting pet insurance, and it's you know, it catches your eye and it's memorable, and you know that's something you might even go home and you were only one person who walked by, but then you might go home and like you know tell your family or tell your friends that, hey, I took a picture. I just saw this like very cool bus stop ad in what is normally a very boring bus stop, and talk about it. So it's got like a multiplier effect. The other thing is that you don't. Oh, sorry. Go ahead,
No,
Neil.
I was just gonna say,
Go ahead.
I see Ironic Ape is a listener here. He did an awesome analysis as well of where they physically placed those at each of the bus stops to get the maximum foot traffic and eyeballs. And I think that was just an awesome piece of analysis. So I just wanted to give that a quick shout out because I think there was some alternative locations that they could have put it at, and then they just they had very specifically chosen these to maximize that foot traffic. So it's also just like they must be utilizing a lot of data to really understand, product placement for that. Actually, that was another thing. So this is one thing I've been wondering, right? Where, more recently they have been doing more sort of top of line advertising. And I know that they're very, data driven. It does make me wonder, like, how are they measuring the effectiveness of these sort of like brand building advertising campaigns that it's not so easy to get a measurable ROI on? Have you guys thought about that?
Yeah, I mean, obviously you will get a certain amount of more sales immediately for people going to the website. Like, I think the first thing you do would probably see, all right, in this location or this community, like, are we getting more traffic to the app and the website? Because your app and website is going to be able to monitor live the amount of traffic you get from different IP addresses in different locations. So you can see, all right, are people at least curious enough to like go to the website and app, even if they don't sign up based on it? So that's like the direct thing you can measure, but the thing you can't measure is in advertising, it's kind of known that it takes like 7 or so repeated exposures in general to really resonate or get a call to action from a user. So the first time like let's say Coca-Cola does a billboard ad or something, someone sees it, they kind of forget about it. The second time they still forget about it, but by about the seventh time, then they're like, it's like in their mind and they know about it and it's more top of mind. So these things are gradual, and it maybe like the first campaign doesn't have a huge direct impact, but over time they build up and they make a difference, and it's a long-term investment. It's not really a short-term direct CAC investment where you're going to just put in a YouTube video call to action to sign up, targeting people who have pets or whatever.
Yeah, I was surprised when I saw the pictures of the bus stops that there wasn't like a QR code or something that people would be able to scan that would also allow Lemonade to track how many people actually visited the site based on that particular bus stop. It just had like the generic URL, so I think it's hard for them to track what the effect is of a bus stop like that.
Yeah, I feel a QR code might be a little ugly, so and Lemonade cares a lot about design, so that might be
Yeah,
why it
yeah,
wasn't.
absolutely. I think like if they want to include a QR code, they should include it in the drawing, like have a cat hold up a sign with the QR code or something like that, not just a boring QR code.
Yeah, yeah. Um, one thing, for branding, some people say, anyone can just copy Lemonade's brand, and it's actually been done in the early days. I think it was Liberty Mutual made a basically exact copycat brand. And this is on the Lemonade blog. They've got like an article from like 5 years ago on it. But they literally copied like Lemonade's like their logo design, the text font, the images. Uh, if they had changed the color to pink and did Lemonade's logo, you would almost think it's Lemonade's website. But then guess what happened? After like a few weeks, they actually shut this down, and it was for selling renters insurance. So it didn't last, but it was a short-term copycat from a major insurer in Liberty Mutual. And I think the reason for this is that, anyone can create an imagery of like a friendly, hip kind of good vibe brand, but it actually has to be backed up by like a culture and a business that actually matches the brand. The internal has to match the external, or your customers don't believe you. Like if you're an insurer who's like, really slow at playing claims, they don't want to work with you, they make things hard and difficult. The best branding in the world don't matter because you're just going to churn right away. But Lemonade is more of a deep brand. It's not just the logo. So they're a B Corp, which means they don't retain. Their interest is not 100% for shareholders. Their interest is also in providing benefits to society. And that's how they have the Give Back program, which gives back to charities when people sign up, which is another thing. People sign up with Lemonade, they select the Give Back. It gives people something good to feel about when they sign up for insurance. It doesn't feel, like they're just in a like a game theory. They're just competing against someone else. There's intermediary there. So there's an internal aspect to it, and they pay claims fast. So other insurers, they pay claims slower. They want to retain that value. They want to get more interest income. But Lemonade is counterposition, where we want to pay you as quick as we can. We want you to have the best experience that you can have. So I think the internal and the external has to match, and that's what makes a strong, cohesive brand, which is what Lemonade has done. Hey, Bradford, I see your hand is up. Do you want to go ahead?
Yeah, I was wondering with the bus stop, can you measure just activity by prospects, by zip code? So if you're only running the bus stop in a certain city, then you can see the change and the behavior of that city versus other cities.
Yeah, well, in Belgium that doesn't work. If I use my mobile internet connection, then websites always think I'm in the capital city instead of the city that I'm actually in. But maybe it's different in the US.
You get the address of
They can
you get the address of someone who signs up.
Yeah.
Yeah, but someone who signs up, you don't know whether they came to the website via the bus stop, right?
Yeah, I mean, obviously, when you do a marketing campaign and you don't see anyone like visiting your website or in that general zip code or in that general area, then the marketing campaign probably didn't do a great job. But it's still kind of for long-term general brand exposure, brand awareness, that kind of thing. It's not meant to drive the highest efficiency in CAC, basically.
Yeah, absolutely. I also have an idea actually for them, because you're right, Lemonade is trying to do good in the world, and they showcase that especially with their give back program. But I actually think they should showcase and celebrate more of the claims they're actually paying out and how they're helping their customers. And maybe like the shareholder letter isn't really the best place to do it, because people reading those are more interested in the financials, and maybe they don't want to read like, hey, we paid out so many claims or we helped so many customers. But maybe on the website, given that Lemonade has such an integrated computer system or IT system and an AI network, maybe they just could put a live feed on the website, like, hey, we just paid out this amount of money to Jesse because his to fix the broken leg of his cat, or I don't know, just have some positive news on the website about how Lemonade is helping customers in real time. They could do that. They're probably the only insurer that could do that, actually.
They need to hire Sarah McLachlan to do a song. Y'all don't know that ad? What was it for? Like the ACPA?
So sorry, Brad. I see you sort of got your hand up again. Did you want to jump in again?
I think it's an error
Go
with
ahead,
the
Richard.
space. I don't.
Oh, okay. Hey, Ironic Ape, I saw you've just come up as a speaker. Want to say a few words?
So I'm currently underground on the tube, so it'll be pretty hard to hear me. I was just going to say, in terms of the location for the bus stops, I don't think it's beyond the world of possibilities that they can just geolocate based on the mobile device when they're at the bus stop, or just based on the rough locations of when someone's landing on the website. They should get a rough idea. It's never as accurate as a QR code, but I think geolocating on mobile device data could be pretty reasonable these days.
Does the app have the app have location tracking, right? So as long as that's on, I mean, they should know exactly where you are when you visit the app, right?
Exactly.
But I guess my point is, like, you would have a baseline for the city, how that zip code is doing. So if someone just quotes renters insurance, or they quote homeowners or auto insurance, they're going to include their location in that. So then they would expect to see a pickup in inquiries from the location with the bus stop. But I agree with Brian. It'll take time. So, like, I'm not a marketing expert, but I did do some YouTube ads for a while, and I think I did them for about maybe 6 months, 6 to 9 months, and then I stopped. And what was funny is I actually got clients after I stopped, and it was like a couple months after I stopped, and they had just seen a number of the videos, and they kept watching ones even after we stopped sending the ads, and eventually those people converted.
Yeah, I think so. I've done a good amount of advertising actually. Last year, I spent over $400,000 on Meta ads, and there is definitely a way to see if your audience that you're advertising to is getting warmer. So in many cases, like, I think like these bus stop ads, while they probably do drive some direct conversion, I bet what Lemonade notices is people who see those bus stop ads. So the people that they're advertising to on Meta or whatever platform in Chicago probably have higher conversions after seeing the bus stop ads, even if they don't sign up directly when they see the bus stop ad, if that makes sense. So it's like, it's a lot of these like real world or even like TV ads, they're mostly for helping Lemonade or whatever company is advertising take more mind share, so that they're warmer in the moment when they actually need the product. So I don't know if that's helpful, Brad.
Okay.
All right. Well, while we're on the topic of advertising, first I want to ask everyone, if you're using your desktop, I'd like to do like a quick experiment here, especially if you're US based for Lemonade Sales Insurance. But even if you're not, like, if you type in to Google renters insurance and then the state you live in, and if you're not in the US, just type in renters insurance and then put in any state you want. like what shows up for you for sponsored ads? And this is the reason I ask is this is tied to like a case I hear where Lemonade right now, they have like for renters insurance, they're top of mind in Google. Like Google search, renters insurance is like number one for Lemonade. They're ahead of Geico, they're ahead of State Farm, they're ahead of Progressive. You know, they've got more people searching for their brand than other brands. And some people say, well, Lemonade spends so much more on advertising, and you know, Lemonade does spend on advertising, and they do YouTube and they do other areas. But when I go to Google and I type in renters insurance and I put in California, I put in Texas, I put in Illinois, I put in every state. I see Allstate, I see Geico, I see State Farm, I see, you know, AdWords are expensive, and I see all of these, you know, the big legacy insurers. They're the ones spending the big bucks that I see in terms of Google ad spend. And, you know, that tells me Lemonade is doing advertising differently than the big guys. The big guys are like throwing money at it and doing Google, whereas Lemonade is, you know, they're being a little bit more savvy in how they target their customers than just, you know, saying, all right, we got 100 million, drop it all on Google ad spend.
Yeah,
So.
I just, that's interesting search query, because when I do it, I'm VPNing into LA right now, and the first page doesn't even show Lemonade. I see Allstate, USAA, Experian, Geico, and then next is Progressive, Plymouth Rock. Like Lemonade is way down this list on Google. But I do think they focus the vast majority of their advertising on YouTube, TikTok, Instagram, that sort of thing.
Yeah, I actually do see a Lemonade sponsored link if I open an incognito tab and search for renters here in Texas. There's actually 4 insurers advertising on that search query, and Lemonade is number 2 with Geico and Progressive underneath them. But did you guys see the really, really interesting talk from Clayton Christensen? He's unfortunately passed away now, but he was an incredible economist who I think probably deserves a Nobel Prize for his theory on disruptive innovation. But he was giving a talk about how disruptors oftentimes come underneath and take the lowest margin product from the big incumbents. And because they are taking those lowest margin products, it causes the big players to say, you know what, we'll just give that up. Why do we want to fight for this really low margin, to sell this really low margin product when we can just drop it off, focus on our higher margin products, increase our profit margin, increase our profitability, and they pretty much just give it up. It's a really interesting, I think Ironic Ape shared it with Paperback, and then I watched it from Paperback sharing it. It is really, really good, and it just shows you kind of the path that Lemonade has been going down and will continue going down. And it kind of just shows you how Lemonade's eventually going to take the whole market. It's really cool.
Yeah, I think so. Like Clayton Christensen, his book, The Innovator's Dilemma, is probably like one of the most important investing books I've ever read, and I recommend it to everyone. And I think a lot of my understanding of like Lemonade is improved dramatically by the book, The Innovator's Dilemma, for the reasons you just said, Jake. So yeah, if you're on this channel or listening here and you haven't read the book, you know, go order it, pick it up, read it, and I think you'll understand what Lemonade is doing by targeting renters and pet first, and then working their way up to car afterward.
Yeah, I'm gonna.
Jake, not sorry. Just I don't plug my own work, but I think I made the video well before you were part of the Lemonade group, and so I made a video probably about a year or two, maybe 2 years ago, when I referenced specifically this whole thing of the innovator's dilemma, and referenced it with the pet product. So I'll put a fresh link up for that, because I think you might find that well, it ties in well with the main point you were making there.
Yeah, I would say that's actually a must-read book for people investing in Lemonade. It really gives a very solid foundational base of understanding for how these disruptions work. I mean, this goes all the way back to just about every disruption you've seen, right? I mean, for me, that my first big all in was Apple. That was a classic, innovator's dilemma case with legacy phone makers. Same thing happened with Tesla and the legacy automakers. I mean, that's still unfolding today as we see it. And this is, I think, absolutely applicable to what's happening with Lemonade.
Yeah, and it explains so much of not just Lemonade, but all kinds of things. If you want to know why, Google and all these other tech companies are taking AI so seriously, like Google is disrupting themselves by sending people to AI search stuff instead of their normal search inquiries lately, because they take ChatGPT and all these other things as a serious threat. So whereas Geico, I think maybe a few more people there should, and as an investor, maybe they shouldn't. But if they knew what was good for them, they'd probably read the Innovator's Dilemma and think, gee, maybe we should do a little bit more than dabble in AI. Preston, you had your hand up.
Yeah, I think one thing I wanted to add too was during Neil's interview, Daniel had talked a little bit about kind of like I don't think he talked about the book specifically, but the innovator's dilemma, where especially I think with like some of these like bigger insurers, their shareholder base is very different than Lemonade's. Like the mindset, typically they're paying out some sort of dividend, and they don't really want to rock the boat. A lot of like the leadership, is well established and has been around for a while. So like, they don't want to undergo what would be a very excruciating process to kind of in a way like rebuild their business from the ground up to kind of be more AI/tech first. And so I think that was like a good piece that kind of spoke to why legacy insurers will not just be able to adopt AI in addition to kind of like all the other reasons like we've touched on. Yeah.
So I'm not sure if
Yeah,
there's.
and we
Oh, sorry. Go ahead, Jake.
it's okay. If you want to go, you can.
Yeah, I just because we've my initial thinking, just okay, housekeeping. When I used to do these spaces with Christian, we would typically try to keep them to about 90 minutes. But I'm pretty sure we've got everyone that's here is pretty much a Lemonade investor. So I'm happy to continue. But I'm just sort of curious because a lot of the people speaking up on the panel, we've all been investors for quite a bit of time. I've seen the discourse between a lot of us. I'm just curious if there happens to be anyone that's listening to the space right now that might have any questions that wants to come up as a speaker and just sort of field those to the panel. So yeah, Jake, you can go ahead while if there's anyone else that wants to sort of come up, I'll give them a chance to.
Okay. Yes. Sounds good. I just wanted to make this analogy more concrete that we're talking about with the innovator's dilemma, since I did just listen to the talk by Clayton Christensen. So we saw this exact same thing happen with steel and integrated steel mills, and then these much cheaper electric mills that started coming up. And what was crazy is this innovation was started happening in the early 1900s with the electric mills, and an integrated steel mill is 20% more expensive in actually melting that steel than the new electric mills were. Yet not a single integrated steel mill implemented the new technology. Not one. Which is just absolutely insane to think about. And instead, what happened is as the new electric mills, first they couldn't do the biggest products because they couldn't get pure enough steel. So they would just take the lowest level, the lowest margin product, the worst steel, which was reinforced rebar, and it would just go inside your the stone for building. And because they could do it slightly cheaper, they could undercut the integrated steel mills a little bit. The integrated steel mills never implemented the new technology, despite the fact that it was 20% cheaper, and instead just gave up the rebar market because they were like, well, the profit margin is too low. Who cares about fighting for this? And we are seeing the exact same thing in insurance now, where because of AI, because of automation, because 97% of policies are sold through AI bot Maya with no human in the loop, because 55% of claims are currently already paid by AI Jim with no human in the loop, there is such a lower cost to fulfill a claim for Lemonade than incumbents, but the cost advantage, I believe, is going to be far better than a 20% improvement that Lemonade is getting out of AI. Like, this is a much bigger innovation. It's going to have a lot more cost savings than even switching to electric mill from the integrated steel mill, which saved 20%. And we are seeing the exact same thing happen. So already Lemonade can charge far less for renters insurance because it's such a cheap policy that such a huge percentage of it is the expense cost of actually running an insurance company, is paying the employees to actually deal with the claims and that sort of thing. So already they cannot compete in price for Lemonade, and they're just going to give it up. We are going to see the traditional insurance companies completely exit renters insurance, in my opinion. At least it will be the very first product that they completely exit, because
Well,
go for it.
I think they have to keep it though. Yeah, I think they have to keep it, like, just because they need renters, because they want to graduate renters eventually to other products. So it is a gateway policy that they do. But
already they don't advertise
if they exit,
like, not at the same level. Like, it is so much more profitable to advertise for a car customer, for example, that it's like the vast majority of their advertising budget goes for the customer that's worth the most. I don't think the legacy companies are doing that same Lemonade strategy where you grab a customer cheap for renters and then slowly graduate them and grow up with them. I think Lemonade's the only one doing that.
So one thing, with the innovator's dilemma, and again, this is an important way for how businesses disrupt into legacy, is you need an angle in order to disrupt a legacy industry. And in this case, it was renters and also pet. You have these two industries which are very high frequency claim products. So people for renters make claims more often than a typical product, a typical big product like home. And then you have pet insurance, which people make claims all the time because they go to the vet, and it happens yearly. It's quite often. So efficiency becomes very important in these two lines, and a business that can be more efficient than legacy can basically come in and take them because the legacy businesses can't do it more effective. They can't reduce their cost because of the way that they're currently structured. So it allows for them to go into these lower margin businesses and be profitable when the bigger companies can't really do that as well, and then eventually move up market, which is the innovator's dilemma. But what's interesting about this is now that Lemonade is the one who is doing the low end disruption in products like pet and renters, and they are also now going to go up market to car or expand it, is that it kind of removes future players from the game. How does a future player enter in the insurance market and compete against Lemonade and compete against legacy? Because they either have to face legacy head on by doing exactly what legacy is doing, or they have to find a low end disruption thing, which there isn't one. There isn't a low end disruption. There are some other cases where, like Tesla is doing their own car insurance. So by being a car insurer, they can, they have direct access to customers. So it lets them do things other people can't. Root has taken a little bit of a different approach by being a partner with the point of sale, but there's much less opportunity for a future disruptor to come up now that Lemonade has kind of taken away the low end disruption market. Whoever would try and compete with them would be competing with Lemonade on renters and pet, which would put pressure on their margins and be less profitable than when Lemonade did it.
So that raises an interesting point, right? Because I've always had this mentality that a lot of these disruptors, I can't remember who I first heard this from, but it's typically when they enter some of their spaces, it's a winner take most sort of the way things play out. And I don't see a reason why Lemonade couldn't hold, say, for example, more than half of the entire US's renters market. I just don't see why they couldn't. Or even you could say the same for pet. I think, home and auto much further down the line. Who knows? Let's see. But I really don't see a reason why that couldn't happen for pet and renters. I see.
So I had a question.
Yeah,
So like, at least renters is being portrayed as a low margin business. I thought it's been high margin the whole time, but it was just so small of a market that it was kind of left behind by legacy. So maybe you could clarify that.
Yeah, so it's not
Yeah, sorry,
necessarily.
for renters, Bradford.
Yeah, he's talking about renters. You can take it if you want.
Yeah. Yeah, I mean, the thing about renters is, although from like a loss ratio perspective, legacy may be, pretty solid on renters, there's the cost associated with handling the claim. And my general assumption, and I don't think any legacy insurers are breaking down their cost to serve claims just for renters insurance. I don't think they provide that, but they do. Let us know. But every time that a legacy renters insurance person, they call up State Farm, they're like, hey, I want to sign up for a renters insurance policy, old school way. The guy who picks up the phone call, captive agent or whatever, that costs that agent money. I mean, it's almost like he's losing money, but he's hoping to upsell them on a different product. But like he's almost losing money in the amount of work he has to do to sign up this guy for renters insurance, because it's such a, the overall profit from this customer over the year is not great. Like, he doesn't even want to pick up this call, but he does want to convert you into a home insurance customer in like 2 or 3 years or something. And then whenever this renters insurance guy calls up, State Farm or whatever to submit a claim, the person who picks up the call, they're probably spending more money with people than they are on the claim itself, because how much are you spending per call picking up these people? They're high frequency claims. They're Lemonade offers $5 renters insurance. Like, what is that? $60 a year in renters insurance. You pick up one phone call at State Farm and you're already like losing money with this customer, even if the claim isn't approved. So I just think from a efficiency standpoint, what Lemonade does is they bring efficiency because it's automated. The claims are automated. You do the claim through the app. It goes through. It's automated. Customer support is automated. There's just so much more automation there. Whereas legacy still has people want to call up, and they're older customers, and they often, and they want to call up and they want to speak to an agent. They want to do things the old school way, even if there is an app, and that brings down their margins at the end of the day on that particular product. So that's my view.
So because it's a low premium policy, the expense side of the combined ratio, where you have the expense ratio and the loss ratio, for low margin products, the expense ratio when you're paying humans to do all of the customer interaction can be a bigger percentage of the premium cost than the loss ratio. Whereas for a much higher premium product like car, for example, where the losses are much bigger and the premiums are much higher, then your expense ratio is a lower percentage of that overall policy. So it is super low margin. We're saying it's low margin. It's super low margin now for legacy players to try to compete in renters with Lemonade, which is automated. So it's not low margin for Lemonade because they have bots that can automatically deal with your claim and everything. So it's very cheap for them to handle the claim, which makes the expense ratio part of that low policy or a low premium policy much smaller. So does that make sense, Brad?
Yeah, that's a great clarification.
Bradford, I just got a question because I'm not sure if it's just my screen might be glitching out, but I see that you're sort of alternating between putting your hand up and 100%. I assume that's a glitch. So I'm not sure if you're trying to speak sometimes.
Yeah, it should be down right now. It's down on my side.
Okay, it's still up on my side. That's okay. Sorry, just housekeeping. So we got the compounder, I think, just come up as a speaker. Did you want to ask questions, say a few words?
Hey everyone. Yeah, I was thinking, I just wanted to add to the competition topic. So I don't think, probably most of us would agree that the traditional insurers won't be competitors anytime soon. But recently, after watching the Robinhood event and seeing what they're trying to build, I think like companies like Robinhood potentially can become like a more longer term, can become a competitor once they have of the financial data of their customers. I think they can easily build an insurance product that can compete with Lemonade. But that's I don't think like that's at their side at the moment. But if they want to build like all-in-one like financial platform, I think it can be a thing that in the future. And I think like for companies that are like Apple size, I think the market is too small for them to kind of focus on this. But for Robinhood, I think they can just add it as a product that doesn't make much money from it. Yeah.
Yeah, I don't think it's a matter of the market being too small, because it is a $7.5 trillion global market. It's very, very large. It's one of the biggest markets in the entire world. The issue is, so other people have been saying stuff like, you say Robinhood. I think Antonio brought up Meta. The reason that these companies are not going to compete with Lemonade is, first of all, I think people who say this are greatly underestimating the complexity of creating a successful insurance company. Like, how many billions of data points you need to even get your underwriting decent so that you're not losing money on these claims that you're rating. But the main reason why I don't think a Meta, for example, or even a Robinhood would try to compete with Lemonade in the next decade is because insurance just doesn't seem attractive to tech companies, because the traditional margins on insurance are very low. So Meta, for example, they have very high operating margins. They have very high net profit margins, and insurance would be getting into a lower net profit margin industry, which would make Meta's shareholders very unhappy because they obviously want to see profit margins continue increasing. So I think Robinhood is kind of in a similar vein. I do think that like Robinhood has really good engineers, right? So I'm not saying Robinhood doesn't have the engineering talent, doesn't have the technical talent to build an app as good as Lemonade. Like, that's not what I'm saying. I'm just saying it's not going to be attractive enough to them when there's so many more innovations and so much more market to take in their main business, that I just don't really think it's a fear. Now, eventually, someday, when you're thinking out 10 plus years, Lemonade is going to change the profit margin dynamic of insurance. Lemonade is going to make insurance look a lot more attractive than it looks right now, which is partly why we have a big advantage, and why Lemonade is so mispriced, in my opinion, because people are pricing Lemonade as a small insurance company that can maybe get as big of as a Progressive or something if they get super lucky. And then they assume that they're only going to be able to get to the same profit margins as a Progressive if they get as large. They're not thinking about the fact that when you completely automate the insurance business, the net profit dynamic changes drastically, and we really don't know what the profitability potential is of Lemonade. So 10 years from now, maybe it changes. And then maybe in 10 years, Zuckerberg is interested in insurance because he sees how much profit Lemonade's printing. Maybe in 10 years, a Robinhood is interested in insurance because they see how much profit Lemonade is printing. But right now, they're not going to be interested. And then 10 years from now, I think Lemonade's advantage is just going to be far too big by that point. So that would be my take.
Yeah, so my take here is we have to kind of separate the businesses out here. Some businesses are customer aggregators, and their specialty is aggregating, the customers into one spot. And then some are special at other things, and some do both. And if we look at Robinhood in particular, their focus is on being a customer aggregator. They want all the customers to come to them, and then they want to sell you, specifically their product is, things related to like investing and holding your money there. But if you look at things like their mortgage, they're not underwriting their mortgage product. They're using a third-party bank to do that. So if Robinhood was to offer insurance, I believe it'll be the same strategy. I believe they want to increase the amount of money that they can make off of their customers. And what that means for them is, if they were to offer insurance, they would offer you insurance. it would be underwritten by someone else. It might be underwritten by Lemonade. It might be underwritten by Root. It might be underwritten by Geico. And it's just a way for them to increase the revenue that they get from their customers. They're not interested in learning about underwriting. They're not interested in figuring that out. That's not really a product for them, and that kind of splits their focus. Their focus is on their technology and their way to increase the customer experience that they have. So I have 0% concern about Robinhood kind of entering the space. It's just a customer aggregator in my view, and my same view is for Meta and all these other tech companies. They aggregate people, but a business that tries to do everything generally is going to be more mediocre at everything versus a company that is more focused, because a focused company has more skin in the game in what they're doing, and generally you're going to see better results there. So you've seen Meta try different things. They tried to become Twitch. They tried to do other things. Sometimes they work on things, but oftentimes they retrench back to what their core value add is. So that's my view. I'm not worried about a Hood at all.
I'm interested in
might Lemonade be a acquisition target?
Hey guys, so sorry guys,
Well,
I was just going to jump in because I've got to quickly jump on a train. And I'm going to leave in about 2 minutes time. I lost you guys when I went on the tube, but I just wanted to call out in terms of the innovator's dilemma and the underlying expense ratios. Like one of the things I'm super excited about is the fact that they're actually acquiring the customers at an absolute low value of CAC, like $350 per customer. When you look at it on a per customer basis, that's awesome compared to some of the competition. Like Root's about $1,350 per customer. So when you start cross-selling the higher premium products into this existing base, the efficiency ratios for LTV to CAC suddenly flip and they become incredibly advantageous. And I think that's, the market's been absolutely dumping on Lemonade as the percentage ratio of net earned premium versus the spend on SG&A and their marketing spend. But now that they're retaining a lot more of that risk through the new model, the net earned premium and the revenue is going to significantly increase over the next year or so. And that ratio just on its own is going to become much, much more efficient. And then when they start cross-selling, even 1/12 of their existing customer base over to car, they massively outperform on an LTV to CAC basis to a lot of the competition, and suddenly it becomes an incredibly powerful story. Sorry, I'm gonna pause there because I'm gonna jump on a train and I'm probably gonna lose you, but feel free to carry on and I'd love to listen.
Thanks, Veronica. Yeah, I mean, I agree 100% with that. That's the big deal, is upgrading their customers and increasing their the amount that they make from each customer by upselling them to car, which is the big kind of money product. Bradford, I think you had something to say as well.
Waiting into insurance, might they be
I'm not sure if it's happening
You're
for anyone
breaking
else.
up to me.
Yeah, you're breaking up.
Yeah, I just heard insurance, and I think you were talking about Hood, but I couldn't make out what it was about.
All right, I just reconnected. Can you?
Yes. Yeah. Now we can hear
Yep,
you.
now I can hear you.
So, what if Robinhood is instead an acquirer of a fintech insurer? Do you think there's some potential in that, like Robinhood or SoFi?
So me
If
personally,
Lemonade was willing to sell at some point, I'm sure someone would be interested in acquiring them. But I really don't think that Daniel and Shai have any interest in selling. I don't know, Neil.
yeah, no, that's always been my sense as well. I mean, just based on the conversations we've had with the guys, I think they sort of see this company as their legacy, their mark on the world. And I don't really see them sort of exiting so they can, buy an island and just go hang out on the beach. They don't strike me as those kind of guys.
My sense is they're putting in a ton of effort into the AI and into long-term focus. And these are things that they do benefit today, but they also benefit much, much, much more like 2 years from now, 3 years from now, 5 years from now, 10 years from now. So, based on the way that they're doing everything, it's not really to be acquired, the way I see things. So I imagine they would like to see all of the fruits of their labor, kind of grow over the coming years. So, uh, could they sell? Sure, but I don't think I don't think that's in their game plan.
If you look, I think Neil brought this up, and he had a conversation where Shai mentioned this to him. Um, Lemonade's platform, Lemonade's autonomous platform, is built for 10 million plus users. So the reason why their combined ratio has looked so bad is because they have a huge percentage of their employees are engineers that are coding this autonomous platform for 10 million users. So obviously when you only have 1 million customers, only have 2 million customers, it's like your combined ratio is not going to look that good yet. But we are seeing that improvement every single quarter. We're seeing the direction it's headed. And if it's true that they can go from now 2.5 million customers to 10 without any real increase in headcount, it's like the market is not ready for this. The market definitely does not believe this is going to happen. But if you're thinking about it from Shai and Daniel's perspective, they're like, we have this 10 million customer platform built where we can just keep adding these customers now without adding employees. It's like, why in the world would they have any interest in selling before they show the true value of what they've been building for this last decade? It would be silly of them.
Yeah.
Yeah. Personally, I would oppose any kind of buyout. So, and I would be very public and vocal about it.
Yeah, very, very much echo that sentiment. And I think we can all agree here that the value of this company is, and their future, when they get to something like 10 million customers, is going to be so immense. So it would be, just, I think foolish to sell anywhere near these levels. But I do think there's a possibility at some point in the far off future that a company like Lemonade could be acquired by one of these really large tech companies. I've always thought that, and this is from, this initial thought came to mind maybe like a couple of years ago, where if I was thinking through who might be the most sensible acquirer of Lemonade, the one that always sprung to mind was Apple. And that was because it was around the time when they had launched the Apple Card that I was thinking about this, where, if they're trying to build this sort of hardcore customer stickiness where they've got, financial services, banking, and various other products, like insurance does seem like it would be a natural fit. And I always sort of thought if you sort of like, fast forward how, technology is developing, how wearables are developing, that it could then be a good way for them to branch off into maybe even covering health insurance at that point. But I know that health insurance is a whole other level of complexity. So I haven't spent too much time thinking about it, but just more at a conceptual level, it did sort of make sense that, someone like an Apple maybe would think about acquiring them and, porting that all that functionality into their ecosystem.
If it's for more than $500 billion, then I might not cry myself to sleep for that many nights in a row.
Be crying on your yacht, Jake. All right. Are there any topics anyone wants to cover while everyone's here? I feel like we've been going for about little over 2 hours now. So, want to save some for the next space that we do. Neil, anything else you think we want to cover?
I just shared this little wholesome post. Maybe we could end on. Sorry, Neil. I completely
go
cut
ahead.
you off here.
Go ahead.
But if you guys saw this, I thought this was really cool. The founder of Oscar Health, Mario, just posted in response to Shai's happy birthday post. He said, happy Lemonade customer, by the way. So that's the founder of Oscar saying that he's a happy Lemonade customer. And then Shai Winninger responded, thanks, Mario. Oscar Health was always an inspiration. And then Brian Shared with me a piece of information I didn't know, which was that Oscar and Lemonade actually shared the same building before they were both public companies.
Yep.
And both we're looking up to each other as building these autonomous insurance platforms. I don't know if you want to share anything else on that, Brian.
Yeah, so way back in the day, before they were public and they were still, building up their technology platforms. Yeah, they both. Well, for starters, they both were. They had seed rounds by Joshua Kushner. I assume they were called Thrive Capital still at the time. But yeah, they both were seed funded, and they shared the same building. They were like a floor apart, and I've actually, I've talked to someone who worked at Oscar, and he said they used to do like a ping pong tournament with each other. So, the early Oscar team and the early Lemonade team we're on pretty good terms, and working and building their companies together. So yeah, that was kind of cool.
Yeah, one of the other things I picked up on from Shai's long post, I think that was at the tail end of that, was that I think it was Ashton Kutcher. Kutcher, am I saying that name correctly?
Yep.
He was an early investor in Lemonade. I had no idea about that until I saw that post from Shai.
Yeah, he has he's made a few posts about it. I think there was another post way back in like 2019 or something. I don't know. It was like long ago by Shai where he showed a picture of way back then when he was checking out the app. So yeah, pretty cool.
Yeah, I thought that was pretty neat. Anyway, so I think we'll sort of wrap up here. We've gone on for, like you said, just over 2 hours. Great discussion. I think that definitely next time there's a few topics I want to cover. I don't know if you guys have put a lot of thought into this, but one of the ones that I wanted to cover was, I think in this big, beautiful bill, I think it's within that. It might be from something else, but there's apparently a 10-year moratorium on statewide regulations for AI coming up. And I'm just sort of trying to think about, would that have any impact on the insurance space? And if so, could that benefit Lemonade in any way? I'm not sure if people have put a lot of time into thinking about that, but certainly something I'd like to get into at some point. I think we'll sort of end here. Great discussion, guys. Brian, is there anything you want to say in closing before we wrap up?
Yeah, just thanks for everyone showing up, and I'm gonna try to see if I can like upload this maybe to YouTube so people who like joined late can catch the whole conversation. This space is being recorded, so you can still catch it on X, but I will try and upload them so that it's easier to find, a month from now, 2 months from now, than just scrolling through X feeds trying to find it. Yeah, so other than that, thanks for showing up, everyone. And let us know. Send Neil and me a message if there's any particular subject you'd like to see in the next time we do a space.
Great. Okay. Thanks, everybody. First one in the books. See you guys next time.